U.S. 10-year Treasury yield hitting 3% for the first time since June after the strong private payrolls data this morning. This as we await the Federal Reserve interest rate decision. It is due out later today. Joining us now to discuss all the market impact, our senior economics reporter Steve Liesman and Credit Suisse chief U.S. equity strategist Jonathan Golub. Steve, as far as what we can expect today, I guess no news conference or economic forecasts. Are we looking out for some clues in the statement?
Yeah, I mean, the Fed basically wants, I think, to get out of this meeting holding intact the general market forecast that they're going to raise in September. There's no hike expected this meeting. Our Fed survey has a 90% probability the Fed hikes in September. That is, by the way, in line with the Fed funds futures market. And then a pretty good probability for December. So I'm actually going to be watching how the December probabilities, and of course the 10-year note, now over 3%, and the 2-year as well, how they react. Do they sort of make it seem like December is more baked in or less baked in? There are your probabilities. And just to explain this chart real quick, June 19 is the next place where we get over the 50% probability of that hike. So you do a quarter in September, a quarter in December, and then the next quarter comes in June. It's been sort of a June-May thing. So also, Sarah, I think it's a little early yet, but start to think about how all this affects the 2019 outlook for Fed hikes.
Jonathan, is that already baked into the market? 2 more hikes this year, and is there anything the Fed could put in the statement today that would disrupt markets?
Well, I mean, first, that was a really great chart. What it basically said was September is a done deal, and the entire discussion on around the Fed statement today is what happens in June. I think what you're going to hear from the Fed is the economy is really, really strong, and you're starting to see continued upward drift on inflation. Whether they become a little bit more hawkish in their tone, but the underlying data is showing that that they should probably continue to move forward, and the market's telling you that it doesn't care, and that's probably the most important thing. When you've seen interest rates rise over the last month or so, the stock market is continuing to do really well.
So we can tolerate higher rates. Is that
you absolutely? Yeah, and I think there's a tipping point. But I like to look at where on the 10-year bond yield you can go before you have a problem. I think a full 3.5% on the 10-year before you have a problem, and maybe, and we'll talk about it later. But the yield curve is something I think that we're going to be increasingly look at, whether it steepens or flattens.
What do you mean by a problem?
Once you get past a certain interest rate, companies have a higher cost of financing. You have individuals who can't refinance their mortgage and take money out of their homes, things of that nature. So at some point, so when rates are really low, rising rates basically say the economy is healthy, this is great, but too much of a good thing isn't good. And then all of a sudden you have the other flip side was, yeah, but it's harder to finance your home and your business.
Sure.
The next 50 basis points, which I don't think we get to in the next 6 months, it's still a positive for the market.
Steve, how does the Fed look at the yield curve? How do they address that? And does a 3% level on the 10-year matter?
As we reported at the last meeting, there was a paper presented that said the Fed should look less at the 2-10 and more at near-term spreads, which basically give an outlook for the Fed and Fed rate hikes, that there's no sort of magic in this 2-10 spread that once it hits zero, it absolutely forecasts a recession. The idea is when rates are, when the outlook for Fed rates are higher, the market expects better growth. When it's lower, the market expects a recession. So I don't know how much that whole idea has sunk in throughout the Federal Reserve Board. I think the Fed chairman thinks about that idea that maybe the 2-10 spread itself is not the one to watch or the one to worry about inverting. That said, I know there are some Federal Reserve Bank presidents, Bostic from Atlanta is among them, who are concerned that taking that next quarter point hike will end up inverting the curve and creating a negative situation for the economy. At the same time, Sarah, you've got 4.1% GDP in the second quarter, forecasts hovering around 3% for the third quarter. That, in the Fed's view, will be above potential. The ADP report this morning talked about 200,000 plus jobs. That's above what the Fed believes potential is. I think there are so many things that lock the Fed in to thinking it ought to raise rates that the 2-10 curve may be, I don't know what Jonathan thinks, but 6th, 7th, or 8th down the line.
Well, and then there's also this idea that whatever's happening in the rest of the world is impacting our bond market, right, Jonathan? There was more drama in the Japanese bond market overnight. Yields there shot up. I like how the Journal calls Japan the spiritual home of low interest rates. Can't last forever. Well, and we know that this has an impact on our bond market.
And what the Fed knows, and what I think we all know, is that the reason that the curve is as flat as it is because Japanese yields and German yields are so low, and they're holding down the long end of the curve. So it's not really as good a signal on the health of the U.S. economy as it normally would be. So even if the Fed inverts the curve, and I think Steve raises a really good point, if you look at, let's say, the 3-month 10-year,
right,
it's telling you that everything is very healthy. So on one hand, the Fed knows that this is not giving you a doomsday outlook. On the other hand, if investors have been trained to look at the 210s and see it as a signal, can it be self-fulfilling? And that is the risk here, whether investors will look just beyond, the simple chart they put up.
Historically, when we have inverted on 210s, market goes higher beyond that for several months, year and a half sometimes. Yeah,
we did a report on this. So somewhere between a little over a year and a little over 3 years is when things go bad. So you have some time, and it's not really clear. If you would have when you watch the curve invert in 97, 98, and if you would have gotten out of the market, you would have missed 50% upside in the market. So, it's a signal, but you got to be careful with it.